how are you going to kick the can down the road from this one? I mean, this is too big. It's a tsunami, which is going to completely wipe out markets, in my view. I think it is a very, very important point that what the central banks are doing is they're not buying gold, they're selling fiat currencies, because they understand the difference between money without any counterparty risk and currency with counterparty risk. So what they're telling us is, hold on, this whole system is looking a bit dangerous. Let's put it that way. Normally, I would expect silver to rise at about twice the rate, maybe slightly less than twice the rate that the gold price does, and it hasn't. Now, it has actually performed more or less in line with gold, but what's happened is that this is because the gold-silver ratio has remained very, very high.
Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pinned comment. Stay ahead of the curve. Don't miss out.
This is fundamentally a dollar-based bubble. The reason it's a dollar-based bubble is that the dollar is the reserve currency of everybody. It is the international trade currency. It is the international commodity settlement currency. It is the international currency, full stop. So we see the dollar going higher and higher, higher, because people are now waking up to this interest rate problem. Gradually, I mean, there's still a lot of waking up to do. It's undermining the other currencies. We now get to a situation where, as I suggested, if we see the 10-year maybe go over 5% yield, which I think it will do in the not too distant future, then I think that will take the equity market out. Then, of course, all the debt problems in other places will start being triggered as well. Bear in mind that the G-SIBs in both Japan and the Eurozone have debt to equity ratios in some cases of over 20 times. Now, that is exceptionally high, and that's come about principally because of negative interest rates. I mean, the only way in which a bank could protect the bottom line was increase its gearing, because the lending margins were just getting compressed and compressed and compressed. So that's what they did. And they're now left with, this sort of enormous debt to equity levels. In America, I guess it's around about 13.5, 14 times. Amongst the big G-SIBs, this is. Regional banks are a different story. Now, the normal level at the bottom of a cycle, in other words, once all this is sort of washed out and all the rest of it, is for these banks to have debt to equities of around about 7, 8 times. Maybe slightly less even. So it's quite a long way to go, as it were, in terms of bank balance sheets adjusting. The problem they have is the only way in which the complete banking system can adjust its total outstanding credit is through their customers going bankrupt, because that's the only way it gets wiped out. Some of it, I mean, the difference you've got to sort of understand that money supply is actually sort of a secondary consideration in this, because money supply is distorted by flows between the commercial banks and the central bank, because central bank, the deposits, if you like, the reserves, as they call it, which are really commercial bank deposits at the central bank, are not included in the money supply calculation. So, banks can increase their reserves, and that undoubtedly is going to happen, because the Fed will go in there, it'll have to buy bonds, because the foreigners and everybody else on the margin isn't going to want to buy anything other than very, very short-term debt. So at some stage, we're likely to see QE come back. Now that will contract money supply, because what happens is it doesn't destroy the credit; it just migrates from commercial banks into the Fed. Other than that, the only way in which this credit gets destroyed is basically when through defaults. So that's going to happen big time. Now, the value of credit, the total value of credit, will diminish, because you will have losses booked to, sort of market losses on the value of credit. And that is really the way the adjustment's going to happen. It's going to be mark to market, if you like, in terms of looking at equities, in terms of looking at other financial investments, if you like. And as far as gold is concerned, of course, it will lose mark-to-market value. I'm talking about the currency losing mark-to-market value against gold. So this is why gold appears to be going up. It's not. Gold over long periods of time, going back even to Roman times, the prices in many things were really quite similar. There is some fluctuation, yes, but it's pretty minimal. Like it might double or it might halve sort of thing. This is individual things. But basically, if you have a sort of a broad-based index of everything, measure it in gold, it doesn't change. What does change, and this is where everybody gets it wrong because they account in these paper currencies, what changes is actually the value of the paper currency. And this is why when we see gold going up, it's really reflecting the fall in the paper currency. But because so few people realize this, they will begin to realize it at a later stage. The thing that's fascinating is if you look at ETF demand, if you like, as a measure of sentiment in Europe, ETF demand for gold ETFs, physical gold ETFs, is pretty much negative in Germany. It's just not increasing. Also around Europe. And if you talk to the retail markets, and I think this is also true in America, you find that people who are hard pressed are selling gold and silver coins because they've got to put bread on the table. There's a lot of that going on. I would say that the futures and forwards markets are doing what they should do. Basically, it's speculators taking a view on where the price is going. They're looking at it. They are inevitably looking at it as gold is going up because you're accounting in dollars or whatever. Okay. The answer as far as physical markets are concerned in the West is that sentiment is very poor. Nobody's really bought into this. They really haven't. If you look at sort of total, sort of portfolio exposure, it's probably less than 1% is exposed to gold. Now, given that gold is real legal money, that's an extraordinary situation when there is so much risk around with all the debt and everything else. It's bizarre. A lot of it is due to the fact that the Americans have run a very successful propaganda campaign trying to remove gold from the financial system. And so for the last 50 years, people have come to believe that rather than, the reality, the common law reality, plus the accounting reality, the difference between money and credit. So the sentiment just isn't there. And we're beginning to see a little bit of demand coming for ETFs. Now, I think that demand, we're seeing it more in America than we are in Europe, but I think that demand is from, investment managers, big investment managers who are not necessarily buying into the concept of gold, but see that the price has been rising, etc., etc., and this is something which makes sense to include in a portfolio, if you like. I'll put it no more strongly than that. So I think we're seeing that sort of advanced institutional demand. What tends to happen with a bull market, if we can just think in those terms rather than the true terms of the relationship between gold and credit, what tends to happen is that you find that the speculators will begin to drive up prices first. You will then find that more serious players will then get in on the bandwagon, and the last people to play are the public, because they will have seen that something has risen and it's risen and it's risen and it continues to rise, and therefore you've got to buy it because it's obviously rising. It's obviously rising. This is the place to be, particularly if everything else is not looking good. So we haven't got that ETF thing, if you like, virtually at all, except for a few institutions who are beginning to adjust their portfolios. And I think that probably sums up the current situation. Gold has this additional factor that, ahead of the speculators, you've got central banks who begin to look at their reserves and the balance of reserves and all the rest of it, and they start adjusting things. It is a common statement that the Central Bank of China, the People's Bank of China, has been buying gold. That's not the way to look at it. Actually, what they've been doing is dumping dollars. Now that, if you understand the difference between the two, it tells you something extremely important. And this is in common with all the other central banks. And remember, they've been told by Vladimir Putin, who's had his reserves stolen by us, don't trust the West, don't trust their currencies. Buy gold. He's pretty much said that. And, so you sort of think, these guys, I tell you, the central bankers I've met are actually pretty cute. Most of them do understand, sort of, if you like, the outcome for the purchasing power of foreign currencies, etc., etc. It's just they're not in a position really to do anything about it themselves. But, the fact that central banks continue to buy gold, in fact, they're pretty much cleaning out all the mine supply, tells you quite simply that these guys really are in the know. They're ahead of the speculators. The speculators can see it, so they go and buy. The poor old swaps and bullion banks, find that they're getting squeezed. I feel so sorry for them. I'm going to cry bitter, bitter tears. But I don't think we need to dwell on that too long. But no, I think it is a very, very important point that what the central banks are doing is they're not buying gold, they're selling fiat currencies because they understand the difference between money without any counterparty risk and currency with counterparty risk. So what they're telling us is, hold on, this whole system is looking a bit dangerous. Let's put it that way. You could be right to look at it that way. It is extraordinary that here we are in, as you put it, a gold bull market, and the gold-silver ratio is looking at 89 times. I mean, normally I would expect silver to rise at about twice the rate, maybe slightly less than twice the rate that the gold price does, and it hasn't. Now, it has actually performed more or less in line with gold, but what's happened is that this is because the gold-silver ratios remain very, very high. I think we've got a problem here because if you go way, way, way back, silver, obviously, I mean, you had currencies which were exchangeable for silver. Sterling was one of them, for example, until Isaac Newton came along and things changed a little bit then. And also in America, I mean, that was the initial currency there. The money, rather, that was the initial money against which, banknotes or bank deposits or whatever were
got a failing. When you got someone in a debt crisis and the whole thing's failing, and it's likely to trigger complete financial chaos, why have anything in it? Just get the hell out. And the only way you get the hell out is to get out of credit and get into real money, which of course is gold.
Now smash the subscribe button and turn on notifications so you do not miss out our recaps. Enjoy the episode.
I mean, it really is. So I think we just dismiss all talk about it. If anything happens, it will be as a result of the collapse of our currencies, because our currencies are credit. As someone said before a congressional committee a long time ago, the dollar depends on the faith, if you like, that people have in it. The faith and the credit in the US government. So, when that collapses, then there may be a change. And I guess that the change will not be a new BRICS currency, but what it will be, I think, is for defensive reasons, China and Russia putting their currencies onto a gold standard. Now, whether they do it properly or not, we'll have to see at the time. I mean, it's very, very simple to do. So I think that's that's the important thing. Now, in terms of any comparison between the European Union and BRICS, the big difference is that the European Union is a political union, whereas BRICS is in effect a trade union. It's a union based on if you like, free trade between the members. That's the whole point of it. And principally, it's not just free trade, but also the recycling of investment to improve the infrastructure in these countries, to allow for the extradition of commodities and all the rest of it. I mean, for example, the building of a railway from Mombasa on the East African coast all the way through to the Congo is all about shipping out, sort of things like cobalt and copper and, all these wonderful things that are being discovered in the Congo. And in return, of course, the Chinese, are importing capital in. So the currency thing doesn't really matter in a sense. What they're doing is they're importing capital into places like Kenya, Uganda, Belgium, the old Belgian Congo, the Congo, Central African Republic, and so on. The idea basically being that by improving communications, by opening up the country properly, investing in it, then everybody's going to benefit, including China. The only country with a problem in this, I guess, really, is Russia, because Russia is a huge net exporter of energy in particular and other commodities, and does not have imports that match. So she is always having to import other currencies, which is the result, if you like, of her sales of energy in particular. So she's up to her neck in Indian rupees, for example. Now, that's not a very happy situation for Russia. And I think that's why Russia was actually quite keen to push the idea of a gold-backed BRICS trade settlement currency back in August last year, ahead of the Johannesburg summit. But that is now a dead duck. That's not going to happen. If, as I say, if anything happens, it will be as a result of the collapse of currencies in the West. I mean, the other thing, so to respond to your listener's question, or viewer's question, I mean, really what they're trying to do is they're trying to assemble a parallel world, if you like, to the West, so that instead of the IMF and the World Bank, you've got the New Development Bank, which will do similar functions. They're planning, and this was announced at Kazan, they're planning, new precious metals exchanges, wheat exchanges. They're looking at other commodity exchanges and all the rest of it. So the idea basically is to build a complete parallel structure so that they don't rely on Western capital markets to sell and acquire commodities and all the rest of it.
Don't forget to hit that like button. It really helps out the channel. And if you want to stay updated with more content like this, be sure to subscribe and click the bell icon so you never miss a video.